You need to understand something very important right now, and I say this with complete conviction after watching markets for years. The movement we are seeing in Bitcoin is not a normal correction, and it is not just another routine cycle. What you are witnessing may be the early stage of a shock that markets often recognize only after it has already begun. In the last months, Bitcoin surged to levels that few believed possible, pushing beyond $120,000, and then, almost without warning, momentum broke. Price fell sharply, volatility expanded, and confidence started to fracture. When markets move this fast in both directions, history tells us that something deeper is usually happening beneath the surface. If you look carefully, the first signals were already there, but they were fragmented, easy to dismiss, and scattered across different parts of the financial system. Liquidity began tightening globally. Real interest rates remained elevated in major economies. Risk assets started showing sensitivity to even small changes in macro expectations. These are not random developments. When capital becomes more expensive and credit conditions tighten, speculative assets are often the first to feel the pressure. Bitcoin, despite its unique characteristics, still trades within a global liquidity cycle, and liquidity is the oxygen of all markets. At the same time, another signal appeared inside the network itself. Mining costs rose sharply in many regions as energy prices, financing costs, and operational expenses increased. Some miners began shutting down machines. Others were forced to sell reserves to stay solvent. Difficulty adjustments began reflecting this stress, and historically, large shifts in mining conditions have often coincided with major turning points in the Bitcoin cycle. This is not speculation. We have seen similar patterns during previous stress periods, including the mining shock after regulatory crackdowns and the liquidity crises of earlier cycles. But the real reasons go deeper than miners or short-term price charts. What you are witnessing is the intersection of macroeconomics and psychology. Markets today are shaped by central bank policies, fiscal uncertainty, and geopolitical shifts. When investors begin to question the trajectory of inflation, growth, and interest rates, capital does not move smoothly. It moves abruptly. History shows this clearly. In 2008, liquidity evaporated almost overnight. In 2020, markets collapsed in weeks before recovering rapidly. In both cases, the turning points were not obvious in real time, but the warning signs were visible to those who understood how capital flows behave under stress. And now we are seeing something else that confirms this shift on a global scale. Institutional flows have become more cautious. Derivatives markets show increased hedging activity. Volatility indicators are rising again after periods of relative calm. When professional money begins preparing for instability, it rarely happens without reason. Large capital does not move on emotion, it moves on probability. And right now the probability of large price swings is rising. Yet here is the contradiction that makes this moment so important. Despite falling prices and rising uncertainty, the fundamental narrative around Bitcoin has not disappeared. Adoption continues in certain sectors. Infrastructure is stronger than it was in previous cycles. Regulatory frameworks, while still evolving, are becoming clearer in some jurisdictions. This creates a tension between long-term structural growth and short-term financial pressure. Markets often become most unstable when these two forces collide. So, what does this mean for the next hours and days? It means the market is entering a phase where decisions are made quickly, reactions are amplified, and sentiment can shift in a matter of hours. In such environments, price does not move gradually. It moves in bursts, driven by liquidity, leverage, and collective psychology. I have seen this pattern before in commodities, in currencies, and in previous crypto cycles. The early stages always feel confusing, almost contradictory, until suddenly everything accelerates. And that is why you must pay attention to the signals forming right now. Not because anyone can predict the exact next move, but because the structure of the market is changing. When volatility compresses after a decline, when liquidity thins, when participants become uncertain, the probability of a decisive movement increases. This is not fear. And it is not hype. It is simply the way markets behave when they approach a turning point. What I am about to explain to you now is something many people in the market still underestimate, and yet it has historically marked the beginning of the most dramatic transitions in Bitcoin's history. The stress is no longer visible only on price charts. It is happening inside the network itself, in the machinery, in the electricity meters, in the balance sheets of mining companies that operate day and night to secure the system. When the internal engine of a market begins to strain, the consequences rarely remain hidden for long. In the last weeks, mining difficulty has fallen sharply, and this is not a small technical adjustment that only engineers care about. Difficulty represents the collective strength of the network, the amount of computational power securing every block, every transaction, every transfer of value. When difficulty drops significantly, it means something very real is happening. Machines are being turned off, operations are shutting down, and weaker participants are being forced out. This is what we call capitulation, and capitulation is never a quiet process. You must understand the economic pressure behind this. Mining is not just a technological activity. It is an industrial operation tied directly to macroeconomic forces. Energy costs, interest rates, credit availability, and currency volatility all shape whether a mining operation survives or fails. Over the past year, borrowing costs have remained elevated across much of the world. Financing new equipment became more expensive. Electricity prices in key regions rose or remained unstable. When operational costs increase, while the asset being produced falls in value, margins disappear very quickly. And when margins disappear, survival becomes the only priority. We have seen this pattern before. During previous cycles, especially in periods following major rallies, miners were often the first forced sellers. In 2018, in 2022, and even during earlier stress events, large mining firms liquidated reserves to cover expenses. That selling pressure did not always cause the downturn, but it often accelerated it. Markets under stress behave like fragile structures. One additional force can cause a disproportionate reaction. But there is another layer to this that few people talk about openly. Mining difficulty adjustments can act like a pressure valve. When weaker miners leave and hash power declines, block production temporarily slows, and then the protocol recalibrates. This process restores equilibrium, but equilibrium does not mean stability. It means the system has absorbed a shock and moved into a new balance, often at a different price level and with a different distribution of power among participants. Right now, the data suggests we are in the middle of such a recalibration. Block times have fluctuated, hash rate growth has stalled in certain periods, and reports from major mining regions indicate that smaller operators are struggling to maintain profitability. When these signals appear together, they rarely represent coincidence. They represent structural adjustment. And yet here is the paradox that makes this moment so difficult to interpret. Even as some miners shut down, others are expanding. Large industrial operations with access to cheap energy and strong financing are increasing their share of the network. This consolidation has happened before in many industries, from oil production to semiconductor manufacturing. Periods of stress eliminate the weakest players and strengthen those with scale and efficiency. What looks like weakness on the surface can sometimes be the early stage of long-term strengthening beneath. But do not mistake this process for something calm or predictable. Transitions like this are rarely smooth. When forced selling meets thin liquidity, price movements become violent. When uncertainty spreads among participants, volatility rises. And when volatility rises, sentiment can change faster than most people expect. I have seen this repeatedly across markets, whether in commodities during supply shocks, currencies during monetary crises, or equities during credit contractions. The pattern is always similar. Internal stress builds quietly, and then suddenly the consequences become visible to everyone at once. That is why what is happening inside the Bitcoin network right now matters far more than many headlines suggest. Price movements can be emotional and temporary, but structural changes in production, cost, and participation reflect deeper forces. These forces do not reverse overnight. They reshape the landscape slowly, and then, almost without warning, the market begins to move in a new direction. And when that shift begins, it often feels sudden, even though the signals were visible long before the crowd noticed them. Now, you need to step back with me for a moment and look beyond charts, beyond mining data, beyond the daily noise that fills headlines. Because what is really shaping this market right now is not happening on a single exchange or inside a single network. It is happening at the level where governments, central banks, and institutions move capital on a scale that most people never see directly. And when that layer begins to shift, markets across the world begin to react, sometimes slowly at first, and sometimes all at once. Over the past year, the global financial environment has been defined by one dominant force: the cost of money. Interest rates across major economies remain historically elevated compared to the previous decade. Central banks tightened aggressively to contain inflation. And even though inflation has cooled in many regions, policymakers have been cautious about easing too quickly. This matters more than many realize. When the risk-free rate rises, capital demands higher returns everywhere. Speculative assets, especially those that do not generate cash flow, become more sensitive to changes in liquidity conditions. This is not theory. It is the same dynamic that has shaped every tightening cycle in modern financial history. You have seen this pattern before, even if you did not recognize it at the time. In the early 1980s, when interest rates surged under Paul Volcker, capital fled risk assets and sought safety and yield. In 2000, as liquidity conditions shifted, technology stocks that had seemed unstoppable collapsed within months. In 2022, when central banks around the world raised rates at the fastest pace in decades, nearly every speculative asset, from high-growth equities to cryptocurrencies, experienced severe corrections. Markets do not move in isolation. They move within the gravitational field of global liquidity. And right now, that gravitational field is unstable. Investors are trying to interpret conflicting signals. On one hand, inflation pressures appear to be moderating in several economies, suggesting that monetary policy could gradually loosen in the future. On the other hand, government debt levels are rising, fiscal deficits remain large, and geopolitical tensions continue to disrupt supply chains and trade routes. These forces create uncertainty about the long-term path of interest rates, currencies, and capital flows. When uncertainty rises, volatility follows. At the same time, regulatory developments are adding another layer of complexity. Governments are moving from ignoring digital assets to attempting to define and control them. Some policies are supportive, aiming to integrate crypto into the broader financial system. Others introduce new compliance requirements and legal uncertainties. Markets react to these signals not only based on what is announced, but based on what participants believe may come next. Expectations, not just reality, drive price movements. And this is where institutional behavior becomes critical. Large funds, pension managers, and corporate treasuries do not move like retail traders. They operate within risk models, allocation limits, and regulatory frameworks. When volatility rises and correlations between assets increase, these institutions often reduce exposure across multiple markets simultaneously. That process can create synchronized movements, equities, commodities, and digital assets, all reacting to the same macro forces. If you have watched markets long enough, you recognize this pattern immediately. It is the signature of liquidity cycles at work. Yet there is another contradiction unfolding in front of us. Despite tightening conditions and rising caution among institutions, the long-term narrative around digital assets has not disappeared. Infrastructure continues to improve. Payment networks are expanding. Some governments are exploring digital currency frameworks. This creates a tension that makes the current moment unusually unstable. Short-term pressures are pushing markets downward, while long-term developments continue to build beneath the surface. When these two forces collide, markets often become extremely sensitive to catalysts. And that is why the coming days feel so critical. Markets are not just reacting to what has already happened. They are positioning for what might happen next. Every statement from a central banker, every regulatory signal, every shift in bond yields or currency markets can ripple through the system within hours. In an interconnected financial world, Capital moves at the speed of information. And when sentiment is fragile, even small changes can trigger large reactions. I am telling you this not to alarm you, but to help you see the bigger picture clearly. What you are witnessing is not just a price correction, and it is not just a technical event inside the crypto market. It is a moment where macroeconomics, policy, psychology, and technology are intersecting at the same time. And when forces of that magnitude begin to interact, markets rarely remain calm for long. Right now, you are standing at a point in the market where decisions are being made quietly, but the consequences of those decisions may soon become very visible. I want you to understand this clearly. The most powerful moves in financial history rarely begin with noise. They begin in silence, in tightening liquidity, in subtle shifts in positioning, in small anomalies that most people overlook. And then, almost suddenly, the market moves in a way that feels explosive, even though the pressure had been building for weeks or months. Look at what is happening beneath the surface. Liquidity in many markets is thinner than it appears. Large derivatives positions are clustered around key price levels. When price approaches those levels, automated liquidations can trigger chain reactions, accelerating movements far beyond what fundamentals alone would justify. We have seen this mechanism repeatedly, not only in cryptocurrencies, but in equity flash crashes, currency crises, and commodity squeezes. Markets today are highly interconnected and highly leveraged, which means reactions can propagate faster than ever before. At the same time, sentiment is fragile. Confidence is not collapsing, but it is no longer strong. That is a dangerous middle ground. When participants are confident, volatility often decreases. When panic takes hold, markets sometimes reach capitulation and reset quickly. But when uncertainty dominates, every headline, every rumor, every macroeconomic data release can push sentiment in a different direction within hours. This is the environment where sharp, unexpected moves are most likely to occur. You should also pay attention to timing. Financial markets often move around events, not just because of the events themselves, but because of expectations leading into them. Conferences, policy discussions, regulatory announcements, and institutional reporting periods all act as focal points for positioning. Traders and institutions adjust risk ahead of these moments, and sometimes the repositioning itself becomes the catalyst for volatility. History offers many examples. Before major Federal Reserve announcements, before currency realignments, before unexpected policy shifts, markets often became unstable in the days leading up to the decision, not after. But here is the contradiction that makes this moment particularly complex. Even as short-term risks increase, the structural story has not disappeared. Technology continues to evolve. Global financial systems are still adapting to a world where digital assets exist alongside traditional markets. Capital has not abandoned the space. It has become more selective, more cautious, more strategic. That means the market is not simply weakening or strengthening. It is transforming, and transformations are rarely smooth. I have watched markets long enough to recognize this pattern. It appears in different forms across decades and asset classes. Before the Asian financial crisis, currency pressures built quietly before breaking suddenly. Before the collapse of major investment banks in 2008, funding markets showed stress long before headlines caught up. Even in commodity cycles, supply shocks often develop slowly before prices react violently. The lesson is always the same. The most important changes are often visible only to those who are willing to look beyond the surface. So, what happens next is not a question of prediction, but of probability. When leverage is high, liquidity is uneven, sentiment is uncertain, and macroeconomic signals are mixed, the probability of large, rapid movements increases significantly. That movement can take different directions, and no one can know the exact path in advance. But the conditions for a decisive move are clearly forming, and ignoring those conditions has always been one of the most costly mistakes in financial history. I want you to remember one thing as you watch the coming hours and days unfold. Markets are not driven only by numbers on a screen. They are driven by human behavior, by fear and confidence, by expectations about the future. And when those expectations begin to shift collectively, change can happen faster than most people believe possible. What feels calm today can feel chaotic tomorrow, and what seems impossible can become reality in a very short time. That is how every major turning point in financial history is unfolded, and that is why this moment deserves your full attention.